Imagine this. You walk into a store in Tokyo and realize that the everyday prices of imported goods like coffee, phones, or even fuel have suddenly shot up. It's not just inflation, it's the falling power of Japanese yen. But why is Japan's currency, which was once considered as a global safe haven, struggling so much in 2025? Well, the answer lies thousands of miles away in Washington, D.C., where the US dollar has become so strong than it's ever been in years. So in today's video, let's break down why the yen is losing its value, how the strong US dollar is influencing global currencies, and what could it mean for economies, businesses, and even your wallet. So without wasting any time, let's get right into today's video. The Japanese yen has been sitting near its lowest level in decades, and it's not bouncing back easily. The main problem isn't just inside Japan, it's what's happening around it, especially in the US. In global currency markets, currencies don't usually rise or fall in a vacuum. They move in relation to one another. For example, if one gets stronger, the others might fall. And right now, the US dollar is so strong than it's ever been in years, and that's what's pushing the Japanese yen down. So why is the US dollar soaring? Well, I've made tons of videos on that, so make sure you check them out as well. For now, it all comes down to confidence and interest rates. The US economy has been steady, inflation has cooled as compared to the past 2 years, but the interest rates are still high. And that's important because when US interest rates are high, investors earn more by putting their money in dollar-based assets. This surely attracts global capital, and this wave of dollar buying increases its value while weakening the other currencies, especially those with much lesser interest rates, just like in Japan. Japan isn't just watching this happen quietly. Earlier this year, the Japanese government and the Bank of Japan stepped in to try and stop the yen from falling further. They sold off all US dollars and bought yen to push up its value. These moves, known as currency market interventions, did help a little, but only for a short period of time. Because the root of the problem, high US rates, is still there, the yen continues to slide once those interventions fade. Many analysts believe that Japan may intervene again if the yen drops too far. But these interventions are expensive and they don't always work if the broader trend isn't in Japan's favor. This is a tricky situation. Japan has had near zero interest rates for a long time, mainly to fight off economic stagnation and deflation. Unlike other major economies, Japan has struggled for decades with low consumer demand, low wages, and an aging population. These issues make the economy fragile. If the Bank of Japan raises interest rates too quickly, it could hurt the economy. Businesses might stop borrowing, households might cut spending, and growth could slow down even more. That's why the Bank of Japan is moving cautiously, even as the yen weakens. So Japan is stuck between two difficult choices: raise rates and risk slowing down the economy, or keep rates low and watch the yen fall. A weak yen affects many parts of the economy, both inside Japan and globally. For people living in Japan, daily life gets more expensive. Japan imports a lot of goods like oil, gas, food, and electronics. When the yen is weak, it costs more to buy those imports, which raises prices in stores. That's especially hard on families, especially dealing with inflation. It also makes international travel more expensive for Japanese citizens. Flights, hotels, meals, everything outside Japan costs more when the yen is weak. On the flip side, Japanese exporters benefit. Products made in Japan like Toyota cars or Sony electronics become cheaper for buyers in other countries. This can help Japanese companies earn more from foreign sales. But even then, it's not a full win, because imported parts and raw materials become more expensive. So while a weak yen helps some businesses, it hurts consumers and increases pressure on the government to step in. The yen's fall isn't just a Japanese story, it's a global one. Currency movements can affect stock markets, trade, inflation, as well as business profits. A weak yen can shake up global supply chains and change where companies choose to invest. It also reminds us how deeply connected the world's financial systems really are. For investors, it's a signal to watch the central bank decisions closely. For consumers, it's a reminder of how international policies can affect everyday prices that we pay at home. And for governments, it's a tough balancing act between growth, inflation, and currency stability. So the moral of the story is that the Japanese yen is struggling in 2025, and the main reason is the strength of US dollar. The high interest rates of US have been pulling global money away from the yen. Even after spending billions to protect its currency, Japan still hasn't been able to reverse this trend. Until the interest rates in US get slower or Japan takes bigger steps, the yen might stay weak. So this is all from my side. I hope you found this video helpful, and if you do, make sure to subscribe to my channel for more financial insights, and I'll see you tomorrow with another one. Take care until next time.